Hello everyone, this is Zach Gardezi. I'm the host of Money Minutes. I'm also the founder of Wealthstone, a private wealth management firm based out of Scottsdale, Arizona. I'm also a certified financial planner and a private wealth advisor. So on this episode of Money Minutes, I'd like to talk to you about, of course, the biggest news going on in the world still, which is the US conflict with Iran. Notably, I'm going to focus on the top 4 questions I'm receiving from clients right now. So let's get right into it. So of course, the first question I'm getting from clients is, well, what does this do to stock market projections for the year? Now, this conflict has a very strong impact to the stock market, mainly because of the conflict's impact to energy prices. In the beginning of the year, things were looking pretty rosy. A lot of firms were talking about a 10% rate of return for the S&P 500. Goldman Sachs had talked about a 12% rate of return in one of their pieces. So those are pretty good numbers, an average or slightly above average year. Now that this conflict has begun, these projections have shifted quite aggressively to the opposite direction. JP Morgan put out a piece saying, look, if this conflict goes on for an extended period of time and oil stays above $90 a barrel, this could mean a 15% correction, meaning 15% drop in the stock market or the S&P 500 from our levels that we started with in 2026. Now that's, of course, an opposite sort of scenario than what they were talking about in the beginning of the year. Goldman Sachs even put out a piece saying, look, we think 19% correction could be possible for the S&P 500 if the war has a longer duration than expected. So the key is, how long will this war go on for? The longer it goes on, the worse it is. That means the longer that we have higher oil prices, higher gas prices, and not to mention the cost or potentially the impact to the global economy. We're seeing a drop in tourism in the Middle East. We're seeing a lot of people basically being forced to pay higher prices. We're not seeing all of the inflation trickling into the system just yet, but certainly we're seeing it in the energy markets. Gas prices are significantly higher all over the world. When you go to fill up your gas at the pump, you're seeing it right now. And eventually, those producers and those truckers, the grocery stores, the restaurants, they're going to pass on the cost of their higher gas prices as well. So then we should see higher prices overall, or what we normally call inflation. So we already had inflation on my previous video that I talked about. We already have this weird sort of higher than expected inflation going on in the economy anyways, which has given the Federal Reserve pause when it comes to cutting interest rates. And now you have this oil situation that's making it much, much worse. And the expectations of rate cuts have basically gone out the window. I mean, a lot of analysts are talking about potentially no rate cuts this year, and 7 out of the 19 members of the FOMC, so the Federal Open Market Committee at the Federal Reserve, who decides what to do with interest rates, they now project no cuts for 2026. So again, these are all things that will have a negative impact on the stock market the longer this war goes on. So that's the key. Let's pay attention to how long this war goes on. The longer it is, the worse the outcome. So the second question that I get most often when we talk about the US-Iran conflict is, are we heading into a recession because of this conflict? Now, history is really valuable whenever we discuss this particular topic because we've gone through oil shocks before. We've gone through conflict in the Middle East before that's led to sort of situations like this. Arguably, this is probably the worst of them, but we've gone through similar sort of oil shocks like this before. Now, what has happened in the previous oil shocks? Every time it has resulted in a recession, mainly because these oil shocks typically last a great deal of time, 6 months, a year, many years, right? It could be very difficult to bring down the price of oil and to sort of fix all the issues that we're seeing right now. The Strait of Hormuz, which I've talked about in many videos, whenever conflict kicks up in that region of the world, I talk about the strait because the worst case scenario was the strait being closed off. If that happens, you're going to see much, much higher oil and gas prices, and then that eventually trickles into inflation. By the time you resolve this issue, depending on how long that takes, it's not like overnight, the oil taps just turn on and then the oil prices just drop and the gas prices just drop. It takes time for even the solution to work its way into the system as well. So this is where recessions can happen because remember, a recession technically is 2 consecutive quarters of negative GDP growth. And so if we're in this conflict for 3 months or 6 months or a year, we're going to see extended period of time with higher oil prices, higher gas prices, which has a negative impact on GDP, causes inflation to go up. will cause the Federal Reserve to not cut interest rates. So all of these negative factors sort of come into play. The odds of a recession, if this war goes on for, I think, longer than 6 months, is very high. And so that's something clients should be keeping in mind as they watch the news and pay attention to what's going on. When you hear the recession word, it is a pretty likely outcome in a conflict like this. So another top question that I receive is, should I just sell everything in my portfolio? Should I just go to cash and just wait this thing out? Historically, that's never the right choice, mainly because if you completely eliminate your market exposure, well, what if this conflict does end miraculously in a week or 2 weeks? What if the US goals are successful and they are able to get regime change in Iran, and then they put in a sympathetic regime that provides us with cheaper oil? I mean, that is the probability of that is greater than 0%. So that means you don't want to completely exit the stock market, because what if we're wrong? What if the negative part of the analysis doesn't actually come true and then you miss out on those returns? Historically, trying to guess exactly how things are going to play out around the world hasn't been the best strategy. So maintaining some market exposure is key. However, also important is to not be overexposed. I've been talking about this for a long time. I mean, many months now, even going back into the end of 2025, which is when I began reducing risk for Wealthstone client portfolios. I was talking about, look, 2026 is not the year you want to enter with an overly risky portfolio or taking aggressive bets that could have worked out for you in 2025 or 2024. 2026 is one of those years, mainly because we had evidence of geopolitical conflict, tension rising. We have evidence of what could happen with the midterm elections. We know there would be a shift in the Federal Reserve chairman and a complete shift in monetary policy. So all of these things were known. Now, we didn't know exactly the extent of how these things are going to impact the market. But when you have these, types of risk factors, this high number of risk factors, and you look at, as I mentioned earlier, the projections of the market returns were fairly average. Should you take on a lot of risk if big Wall Street firms are saying, look, we expect a pretty average year? My thought process was no. Why take on excessive risk if we're expecting an average year? And now this has paid off quite well for our clients here at Wealthstone, because we have a large money market position for a lot of clients where appropriate. Now, for some clients, it makes sense to maintain a risky, aggressive investment posture because that's appropriate for you and your lifestyle. For those types of clients, you're typically in your working years, you're continuing to invest into your portfolios. So you're really more or less dollar cost averaging. You're buying the stocks that we like as they're coming down in this market. Stocks are eventually going to recover. I don't think this is the end of the world. I don't think this is the end of the stock market. It's just one of those periods where we could see some pretty negative impacts to the market. Now, for investors who are retired or coming up on retirement, it's the worst time for you to take a significant loss because you're living off of your portfolio as well, so it takes you longer to recover. But for those clients who are still growing their portfolios, not touching them, actually adding to them, those clients can continue to take on risk. So it's not a one-size-fits-all approach, but most of the clients that I work with at Wealthstone are high net worth, pre-retirees or retirees. And for those clients, we have reduced our equity exposure significantly. And even as this conflict started, I reduced equity exposure even more because as I saw what was happening and the potential for the blocking down of the Strait of Hormuz and how there's not really a clear exit ramp from this type of a conflict. And frankly, wars in the Middle East, I'm not sure why we still get involved because they don't go the way we expect them to do. They just never do. And so this could be another situation where we're dragged into a long conflict. You can't just walk away from this if the enemy doesn't want to end the war. And so I don't know exactly how this war ends, frankly, but what I do know is that I expect it to last a lot longer than maybe what we're hearing from other sources. And so with that being said, the risk factor and whether or not clients should go completely to cash. Look, you shouldn't go completely to cash, but you also shouldn't be on the highest form of taking risk in your portfolios right now. And if you're someone who is caught up in that, maybe you have concentrated stock exposure, maybe you don't know how to navigate your portfolio because you are quite risky. Look, the S&P 500 is down about 5% so far. As I mentioned earlier, the projections are a lot worse, minus 15%, minus 19%. So if you are concerned about your portfolio, it's still not too late to begin looking at options at potentially hedging your downside risk, at potentially diversifying, maybe reducing some exposure. But it's really important to start having those conversations, because if and when the market is down 10, 15, 20 plus percent, that's the worst time to start trying to figure out how to hedge or diversify your portfolio. So lastly, this question that I received from clients, and again, I don't know exactly how this conflict will end. Nobody really does, right? That's the nature of wars and conflict. However, with my background in studying politics, geopolitics, the economy, studying the inner workings of the Middle East and how it all kind of plays out in these types of conflicts, my base case assumption is that this war, this conflict ends in a scenario where the West, the United States, Israel, ends up striking some sort of a deal with the Iranian government. Not a new Iranian government. I don't think this existing regime will be toppled. I think it will survive. It's very well constructed. They survived a significant attack on their leadership structure. And frankly, it's very difficult to topple any major world power government. And so this is an ambitious goal. I don't think it will play out. I think what ends up happening is some sort of a deal. Both sides walk away badly scarred. Potentially the economy hurt significantly from this. But I don't think this ends in the United States losing the war and being destroyed or toppled or collapsing. I also don't think the Iranian regime gets toppled or collapses either. Frankly, I think both sides eventually, sort of like the Ukraine-Russia situation, have a long conflict. There's not really a clear end goal. Maybe there's a third-party intermediary that has to step in and try and negotiate some sort of a ceasefire or end to the war. Maybe that's China, who has relationships with both sides of this conflict. That could be a new change in the global world order, because typically the United States is the one that mediates these types of ceasefires and ends to the conflicts. But we could see this happen with China stepping in. And frankly, a lot of countries have an interest in the Strait of Hormuz being opened back up. However, easier said than done. But again, this is one of those other factors that leads to my calculus that this war is going to go on a lot longer than what we think, and that will have a negative impact to the economy and the stock market. So I'll end by saying, Wealthstone clients, we're in an excellent position based on the risk management that we've done so far this year. Frankly, I'm very grateful for making those moves because I don't think we're at the end of this downward turn in the markets. And for non-Wealthstone clients, again, if you're on the wrong side of this market and you're still concerned about how to navigate, please don't hesitate to reach out. Thank you so much for watching this video, and hope you all have a great week.